Hello, everybody. Welcome to our webinar, A Little Money Goes a Long Way, Financial Inclusion for All. I'm here with your host, Samuel Baumgartner, and Martin Heimes, one of our leaders at responsAbility and definitely an expert in financial inclusion and microfinance. Before we begin, as you all know, you're muted, so if you have a question, please write it into the chat function, and I will get to your questions at the end of the webinar. A little bit about responsAbility. We are a sustainable investment house that focuses on impact investing. We have 3 sectors: climate finance, so green lending, renewable energy, energy efficiency, sustainable food across the entire agricultural value chain, and of course, financial inclusion, which is the topic for today. So with that, I'll hand over to you guys, and I will jump back in at the end for questions.
Thank you very much, Stacy, for the introduction. A very warm welcome to the audience. Good morning, good afternoon, wherever you are. Martin, very warm welcome to you. Thank you very much for being here. Martin, you're expert, as Stacy introduced, you're an expert in impact investing, specializing in this topic, focusing on financial inclusion over roughly 20 years, at responsAbility about 12 years. Maybe in just a few words, could you tell us what financial inclusion actually is? What does it mean?
Sure, Samuel, and yeah, warm welcome also from my side. Thanks for joining. Yeah, to define the term, financial inclusion is about expanding the provision of financial services to people and enterprises that were excluded from access, that lacked access to financial services. That's what it is in essence. Fairly simple. Now, maybe interesting. Initially, financial inclusion was for some time really about access to credit. Some time ago, that has opened up. Of course, people realized that financial inclusion is not just about getting a loan, but it's also savings, transfers, insurance, all sorts of financial services. That's one. Second, interesting is probably that financial inclusion initially was more on people getting access, and then we're quickly in microfinance. Today, financial inclusion is also a bit broader. We talk also about enterprises that are excluded from financing, from access to finance. And impact investing, what we do, what's our role in this? Well, we can contribute to improving financial inclusion by investing in the providers of financial services. So microfinance institutions, SME banks, so by investing in financial institutions.
Thank you for that definition. Based on that, we would like to see now from the audience, now that you have an idea what financial inclusion is, we would like to ask you the first poll question, and we want to know from you who can actually, in your opinion, who can invest in financial inclusion, amongst which is also microfinance. Remember, this is a multi-answer question. So are these governments, pension funds, insurance companies, development banks, philanthropists, and ultra high net worth individuals, and you and I. In the meantime, Martin, you've been working at responsAbility for about over 12 years. Why don't you give us a bit of an insight of how this has been, and also how your team is set up covering this this investment topic?
Mm-hmm. Yeah, sure. Pleasure. Yeah, I'm with responsAbility now for 12 years. I spent some time in the private equity team for financial institutions, and now the last 8 years I'm doing private debt, so financing with debt instruments of financial institutions. And the last 3 years I'm the responsible portfolio manager. I lead a team of 25 people worldwide that do these transactions for us. Spread over 7 offices. We're quite decentralized. We need to be near to our markets. And in that regard, we cover around 60 countries with the people on the ground.
Quite a footprint. So now we also, in the meantime, have the answers that came in. There's quite a group of people that basically went for a range of the options, and as this title of the webinar goes, it's something for everybody. I think maybe Martin, you want to comment quickly on how this can actually be done, or how this is set up.
Yeah. No, yeah, I think result not surprising. I think you're all correct. So well done. All of these, of course, today are investing in financial inclusion. Maybe over time, what can be said is that initially, certainly public money, governments, and were very important in setting up the sector. And private funding has taken over time. No? So governments are less involved today. They still are, no, and roughly I would say in this market you have around half of the financing that comes from development finance institutions, development banks, and the other half comes from more private sources.
Very good. With this, we see everybody can get involved. Moving forward, now that we know that everybody can invest, or everybody has a possibility to get involved in this topic, Martin, what do you get for your money? How does this look like?
Yeah, let me tell you maybe a bit how we build a portfolio, no, or how funds like us building a portfolio. I mean, first you have to bear in mind that the microfinance institutions that we finance, or at least 99% of them, these are not institutions that issue bonds that you can simply buy on Bloomberg. No, they are not rated mostly. The issue sizes would be too small. So all the investments that we do, they're handmade. No, they're bilateral loans with financial institutions. And the analysts that we have on the ground, they're geographically organized. Each covers a few countries, and we are for a long time we have track record in these markets. They are also quite transparent. We know the microfinance institutions, financial inclusion institutions that are active. If you take, for example, if you take Bosnia as an example, you have around 13 relevant microfinance institutions there. They are organized in an association. They have good auditors, so that these markets are well organized and transparent, and we know them for more than 15 years. We built strong networks, and now the job that we have, of course, is picking the right ones. No, that's the hard work. That's why we need all these people, and we need to pick the right ones in terms of eligibility. No, so do they actually contribute to financial inclusion? Do they have good practices? And then risk. Can we invest? Are they investable? And also return. In the end, we have investors. We need to be profitable, sustainable in our funds. So we have to also see that they pay prices for the financing that we do that are adequate. No? And when we identify demand, then we analyze these institutions. Normally we visit them for this. Right now we have to do this mostly remotely, of course. We have to do our own rating to see whether they fit into the portfolio. And finally, well, all the origination that we do has to fit into an overall fund strategy. You know? So there are limits per countries, and the job of a portfolio manager here then is to link the top-down strategy where we want to be invested with the bottom-up opportunities that we see on the ground.
Cool. So having looked a bit at how we go about to select these companies and how we structure these deals, I think I would also, and the audience would also then be interested, as it also is part of the impact investing approach, how do the borrowers benefit from these investments? So when I as an individual put money in an investment, what am I actually triggering in form of benefit for the borrowers?
Yeah, where does that money go in the end?
Where does that money go, exactly? Yeah.
Look, as I said in the beginning, at the higher level, it's about access to financing. So in this case, it's about the ability to get a loan financing. I mean, if you again just taking the example of Bosnia, so of course you have a couple of banks in Bosnia, and you can get loans from them, but normally you can get a loan if you're employed somewhere, no? And for the self-employed or people working in the informal sector, that is not really possible or very difficult, and they can turn to informal lenders, but that's often getting very expensive and potentially also abusive. So that's where microfinance institutions close this gap. No, so they offer loans in this space to people who have a business opportunity and need funding for this. No, and the sums that are borrowed remain small. So the loans where our funding is also used for, in Bosnia, for example, you had 2,000 to 3,000 euro, no, on average, and if you go to countries like India, you're much lower at $200 to $300. No, so typically, what is taken, why these loans are taken, is for working capital purposes. No, so you have borrowers that buy merchandise and to sell it on. Mom and pop shops are typical microfinance clients, or you have clients that buy raw materials for small scale production. You have livestock for agricultural activities. No, so that's the typical loan uses for these loans. No? So in the end, for micro borrowers, what's in it? It's about getting funding to realize a business opportunity.
And I think that nicely indicates how the title of this webinar sort of came to be, that a small amount of money goes a long way. It's not only from the investor side that you can have a big effect with a small sum, but also on the other side, on the borrower side, it doesn't take much to get things moving. Having gotten these insights from Martin on how financial inclusion deals are structured and how these investments are set up, and also the development and the impact that you can have with these investments, I would like to ask the second question to our audience now, pulling up the poll question. If you had the possibility, how much in US dollars, or also can be your currency predominantly, but in US dollars, how much would you consider to invest in financial inclusion or in microfinance? And while you guys are answering the question, maybe Martin, you could give us a little bit of an insight on how financial inclusion and microfinance has developed over the time that you've been involved in this topic.
Yeah. I mean, evolution, I already at the beginning hinted a bit that focus has been enlarged, no, from only credit to also other products that play a role here. Focus has been enlarged from a focus on microfinance borrowers to also SMEs. So these are things that we see in the discourse here also. Now, in terms of evolution of the sector itself, no, it has grown tremendously. Today we have microfinance institutions or small microfinance banks, no, that have millions of clients. In some markets, there has been a diversification into other products. So institutions start with a single microfinance product and they venture into SME lending, housing lending, home improvement lending, consumer lending as well. We've seen mergers and acquisitions. No, microfinance institutions have been bought by foreign banks as a market entry, or by domestic banks to start this type of retail banking. And of course, we've seen quite a lot on the technology side. No? So fintech's still a bit less in microfinance, I would say. No, it's more on the consumer side, it's on the SME side. But there's a lot of technology used by microfinance institutions. So they're providing digital loans, digital payments, and yes, pandemic also here has accelerated this again. So there's a lot still also to come on the technology side.
So we just gotten the polls. Thank you for that, Stacy. I would say the results are great. We seem to have been able to show you guys either you're already convinced coming into this webinar, or we've been able to convince you, or to show you what your effect with an investment to financial inclusion you can have. Martin, do you want to comment the results also from your side?
Yeah, no, look, I'm already glad. We were a bit worried that we have a majority putting 0 here, so we don't have to discuss that one. That's a positive result. And look, I think it shows that the topic is quite well known also as an investment target, right? And I think historically we know this has really taken off. What was it, 12, 13 years ago, there was a Nobel Prize for Mohamed Yunus, and that made this widely known, right? And then investment solutions were available also for retail investors. And so I think that shows that the asset class in itself is known. The need is still high, right? I mean, also now post-COVID, etc. I mean, the financial institutions we work with, they play a key role also in economic recovery. So it's good news that there's interest for investing in that space.
And I would like to pick up on a specific topic that you've just mentioned on the timing question. I think it's also, given that this has been around for quite a while now, there is also track records on the different parts of this investment. And there I would like to bridge over into the Sustainable Development Goals and kind of look a bit at how this feeds into the financial inclusion component. So most of us, or for those of us who are not familiar with the Sustainable Development Goals, just as a quick recap, the Sustainable Development Goals are a predecessor of the Millennial Development Goals set up by the United Nations, and there are targets that we should meet by 2030 to fight things like poverty, malnutrition, climate change, education, gender equality, etc. There are 17 goals. And here I would like to ask you, Martin, how do these fit into the investment universe with financial inclusion, or how does this play together?
Yeah, I mean, I think at the core of financial inclusion, when you talk about microfinance now, is SDG number 1. That's poverty eradication, and we have to be a bit cautious with this, because if you imagine poverty now as the destitution and poverty very close to malnutrition, that is not where microfinance makes an impact. No, I mean, microfinance, as I said before, is about taking out a loan, right? And so it's always been about the so-called active poor, so micro entrepreneurs that are economically active. I mean, a loan is not for everyone. No, it's not like education that should really be universal, right? But a loan is needed by someone who has a project that needs financing. No, so the link to the SDG 1 is then in that sense, no, that there is a contribution to poverty eradication in the sense of enabling, actively or actively active poor. Other SDGs, I mean, you can actually associate a lot of SDGs with financial inclusion. I mean, you have in India, for example, you have microfinance institutions that have dedicated products to build toilets. Yeah? So you're in the sanitation, health and sanitation space, and a contribution is made there. You have quite a lot in terms of home improvement loans. So specific loan products for specific purposes. School fees are often financed also by microfinance institutions. And so, yeah, you can actually associate a lot of other sustainable development goals with financial inclusion. But yeah, I would say in a way they come a bit second, because the core, of course, is still the financing of economic projects. Finally, gender. No, that's you may know this. This is also put often on the agenda of financial inclusion. That's the SDG number 5. So there is a contribution as well. No, I mean, microfinance from a lending technology side, no, has and still is working a lot with women as borrowers, simply because they turn out to be better borrowers. Yeah? So it's if you want, it comes a bit from the risk management side. It wasn't let's say at the outset, it wasn't the intention to lend to women for gender balancing and empowerment, but it still has an effect. No, so taking part in economic life, being a borrower, so that there are effects of this that you can also link to financial inclusion then.
Very good. And I think depending on the fund or in the investment vehicle that you work together, there's also some that then actually report these activities or these impact metrics as part of their regular reporting to investors in the same way that they do the financial reporting, right?
Correct. Yeah, correct. I mean, impact reporting, huge topic for those on the line that know a bit about this. One of the issues, of course, is that there are lots of different ways to do that. There are no single standards, no, according to which you report impact, and it's also difficult, right? Because if you aggregate a lot, you end up with very shallow indicators. You talk about the number of borrowers and the average loan size, and if you want to be more precise, it's much, to show impact. It's more difficult to aggregate. But yeah, I would say also, because there are so many different standards to report on this, I think it's really for investors also to pick and choose, to look at impact reporting and how it's done in their selection of choosing someone with who they want to invest.
Thank you for that. And with this, we're already coming towards the end of our webinar. I would like to quickly wrap up the main takeaways that we've now gotten. First and key is that the investment size doesn't matter as long as you make sure that the investment achieves your purpose. So we've seen at the beginning throughout the middle from the poll question that even with small amounts you can have a significant impact. With financial inclusion, you're able to finance access to basic financial needs for a group of people that otherwise would not have any access to this, which is one of the foundations to create sustainably create strong societies and economies. And based on the example of financial inclusion, you can contribute to a whole range of sustainable development goals. As Martin has shown, it's not just about poverty eradication, but it can range through sanitation, gender equality, education, etc. So I think one of the very important things is that with this activity, you can really contribute to the achievement to a whole range of sustainable development goals. And with that, I would like to open up the floor to questions. So Martin, thank you very much for being here. Stacy?
Yes, we have some questions. Question number one, Martin, how is financial inclusion faring during COVID-19?
Yeah, that's a good question and an obvious one at that time. Absolutely. Overall, quite well. Yeah, so I mean, microfinance or microfinance institutions, they show overall quite high resilience. No, obviously these times are not without stress. There has been liquidity shortages, no, as borrowers could not repay on time. Less liquidity inflow back into the institutions. There have been cases where restructuring was needed from our side as well, no, the financing that we provide, so that these liquidity shortages or the liquidity stress in these institutions gets mitigated. But on the portfolios, probably the judgment is still a bit too soon. Of course, there are effects on micro borrowers that will take time to digest and resume payment. But we see across the board actually now that collection rates in our institutions pick up again and are back to almost normal levels again. In the end, I mean, interesting is maybe that for microfinance in the past, I think the key challenges have always been the destruction of the base of economic activity. You know, so if there's a natural disaster, if there are conflicts, if people are displaced, that is an issue. No, if there are other shocks and people can then after some time resume activity again, then it has shown time and again that actually microfinance portfolios are quite well served. You just have to give people time. And I think we will see this also in this context again.
Great. Some more questions here. Question for Martin. How is an investor like responsAbility better positioned to lend to an MFI in, say, Bosnia than a Bosnian financial institution?
Yeah, there are a couple of factors. I mean, one is that you know, a commercial bank in Bosnia may not want to lend to a microfinance institution in Bosnia because they still perceive them as a sort of competitor. That's one. Second, in lending to a financial institution that you know, does microloans, so the main assets they have are unsecured microloans, that often is how to say, for a bank is carries quite high capital weight. So regulation basically punishes to make loans to these financial institutions and may then simply not be very attractive for a local bank. But fact is also that in many markets, banks have of course started financing microfinance institutions, no? And they often provide shorter maturities than we can. Sometimes they provide more attractive pricing, sometimes they're more expensive. So they are certainly a key source for non-bank financial institutions in the same market as well. Yeah.
Great. Here's a very specific question. Samuel, you might have to field this one. I've already invested in the responsAbility Global Micro and SME Finance Fund. However, that was the only one available for private investors. Any plans to add more funds?
Well, I think first of all, it depends a bit which region you're talking about. There's always considerations going on to expand a certain amount of product offering. Unfortunately, I cannot comment at this given time to any specifics on this. Also, given that especially funds available to retail investors are not quite as easy to launch as those are for example, institutional investors, because retail fund also requires certain regulatory approvals. So it's not just, for example, companies like us that come out with new products, but it then also depends on the regulator to approve these products to make them available for retail or private customer investors. I hope to have been able to answer that question as good as I can.
All right, next question. Back to Martin. For diversified microfinance funds like responsAbilities, how do you view the risk of microlending through MFIs compared to diversified financial institutions that downscale?
Yeah, yeah. I mean, First, I mean, my immediate reaction is that, I mean, the downscaling of let's say more mainstream financial institutions into micro lending markets overall has not worked well. So actually, successful examples of institutions that have downscaled and are now running, very strong microfinance lending, that there are not so many, right? I mean, there are instances where banks have bought microfinance institutions, but it's often a stretch, when you come from lending to institutions that have financial statements or that are sophisticated to deal with, and then you have to work in the informal sector. It's quite a step. So I think taking the question differently. I mean, if you look at the average more diversified bank in a country, and if you look at the average microfinance institution, we tend to say that risks are, they're not completely on different scales, because microfinance institutions, if you run them through formal rating models, they often end up a bit lower because they're smaller, they're monoproduct, they're not so diversified, right? They may have not the strongest shareholders, but the track record, if you look at the last 20 years this industry exists, is actually stronger than the rating suggests. Yeah, it's a difficult question to answer, also because there's not enough track record yet in terms of data that you can really analyze. But my feeling is, and looking at this market now for the last 15 years, I think risks are there on both institutional types, and they're slightly different, right? But ultimately, they're still in the same category.
Great. Next question, Martin. You mentioned that there are not many fintechs addressing financial inclusion yet. What are the challenges you think technology-based startups and fintechs could solve in the field of microfinance?
Yeah, that's a good question too. I think one of the reasons why you don't see so much fintech in addressing the core microfinance market is that, that microfinance is still a high touch service provision. No? So it's a people to people business, and loan officers of these microfinance institutions, they go out, meet clients. It's a lot about trust. No? Microfinance clients are often those that don't want to walk into a bank branch or don't want to anonymously interact through the smartphone. So there's a barrier there in terms of this high touch that obviously you cannot replace with the low touch business model. That's one. I think fintech is encroaching on the microfinance market, because big data and psychometric scoring. So you will see more and more fintechs that are lending to microfinance borrowers based on data analysis and without a salary slip. No, that's the easy thing to do with fintech approach on people that have a salary. So there will be some competition coming from that side. Otherwise, I think that there is also quite some scope to include technology and from a fintech, so in microfinance institutions, just making them more efficient, using different distribution channels to reach clients, electronic payments. I mean, that's almost a standard today in the microfinance industry. So I think one aspect is this competition I mentioned. Another aspect is this kind of working together jointly. We will also see quite a lot of that.
All right, and I think we're probably at our final question here. Let's see. How much risk versus return to expect with a private investment of 10K, respectively, in what time frame? 2.5 years, for instance.
Yeah, look, in this industry, of the various funds that exist, and I think overall what you tend to see is a return between 2 and 5% per year. And sometimes a bit below, maybe sometimes also a bit above, but it's this area, I think. And that's the returns. I think the advantage that many investors see in this asset class is that the correlation to other asset classes and also global economics are a bit, are very limited. And especially in, COVID situation maybe is a bit special because you have one huge shock everywhere, and you do see this also in our markets, as I explained. But otherwise, these funds tend to be quite diversified. You work through financial institutions, so there's a buffer. You're not exposed to real sector risk. So these are advantages from a pure investor, or say from pure commercial point of view when you invest in financial inclusion.
Great. Thank you so much, Martin. Thank you, Samuel. Everybody, don't forget the handout on the side. That's our impact report where you can see how we put the numbers. And then check us out on LinkedIn for future webinars and other information about financial inclusion. Have a good one. Ciao.
Thank you.
Thank you.
Bye.